The allure of the stock market, with its promise of swift riches, has always captivated the hearts and minds of individuals. The dream of buying at the bottom and selling at the very peak is a universal aspiration among traders and investors alike. Yet, the brutal reality is that the vast majority of participants fall prey to their emotions, buying into assets at their most overvalued points, only to sell in despair during downturns. The elusive art of identifying a market top remains one of the most coveted, yet rarely mastered, skills in the world of speculation. It's a skill that requires not prescience, but a profound understanding of market dynamics, and more critically, the psychology of the crowd. Subscribe now, leave a like, and write any comment. This way, you'll help more people see and hear this message, and I'll know that my work is not in vain. Many enter the market believing that identifying a top is akin to predicting the future, a mystical ability reserved for a select few. However, as the legendary speculator Jesse Livermore meticulously documented through his own tumultuous career, the market provides subtle, yet discernible signals when its upward momentum is waning. These are not grand pronouncements, but rather shifts in behavior, changes in character that, when observed with discipline and objectivity, scream warnings to the discerning eye. The challenge lies in seeing these signals through the pervasive noise of optimism and the relentless chatter of those who preach perpetual gains. Jesse Livermore, a figure who made and lost multiple fortunes, learned these lessons through the crucible of his own experiences. He possessed an uncanny ability to read the market's pulse, to sense when the collective mood was shifting from cautious optimism to reckless euphoria, and from thence, to inevitable decline. His insights were not derived from complex mathematical models, but from keen observation, relentless analysis, and a deep understanding of human psychology's impact on prices. He understood that market tops are not singular events but processes, a gradual erosion of underlying strength, masked by surface appearances. The pervasive belief that this time it's different, or that a particular asset can defy the laws of gravity indefinitely, blinds many to the approaching danger. They are swept up in the collective delusion, ignoring the subtle cracks appearing in the edifice of prosperity. It is at these critical junctures that the market provides its most crucial, yet often ignored, warnings. For those who seek to avoid the painful experience of buying at the top, understanding Livermore's approach to detecting these pivotal moments is not merely beneficial, it is essential for capital preservation and long-term success. Therefore, this exploration will delve into the precise rules and observations that Jesse Livermore employed to detect market tops. It's a journey into the mind of a master speculator who understood that the market, in its essence, is a reflection of human behavior, and that by understanding that behavior, one could gain a profound edge. The ability to recognize the subtle shifts, the changes in character, and the psychological excesses that mark a market's peak is a powerful tool for any serious participant in the speculative arena. At the very zenith of a market's advance, a peculiar and dangerous psychological state overtakes the collective consciousness, a pervasive euphoria. This is a period marked by unbridled optimism, a belief in effortless wealth, and a general disregard for risk. It is precisely at this stage that the greatest number of individuals, particularly those new to speculation, are drawn into the market, often committing their capital at the very prices from which the astute professional is quietly exiting. Livermore recognized this widespread emotional excess as a hallmark sign of an approaching top. During this euphoric phase, the market is characterized by a widespread belief that everyone is a genius, and that profits are simply handed out for participation. Talk of market fundamentals becomes secondary to anecdotes of rapid gains. New experts emerge from obscurity, often individuals with little genuine experience, who readily dispense advice on how easily money can be made. These voices, amplified by a hungry public eager for validation, serve to draw in the last remaining pools of uncommitted capital, making the market excessively overbought and vulnerable to the slightest shift in sentiment. Livermore understood that the crowd is almost invariably wrong at the critical turning points of the market, the tops and the bottoms. At the top, the majority are completely swept up in the bullish sentiment, convinced that prices can only go higher. They ignore any cautionary signals, dismiss any negative news, and ridicule those who express prudence. This collective delusion is a powerful force, blinding individuals to the underlying weaknesses accumulating in the market structure. The very lack of caution, the widespread neglect of fundamental risk, becomes a red flag for the discerning speculator. This period of overbought conditions is not a single day's event, but a process. It's a culmination of prolonged buying, driven by emotions rather than sound judgment. Prices are pushed far beyond their intrinsic value, supported only by the speculative fervor of the masses. The common man, driven by greed and the fear of missing out, continues to buy, while the smart money, those who truly understand market cycles, quietly distributes their holdings, capitalizing on the crowd's insatiable appetite. Therefore, One of the crucial lessons Livermore learned, often at great personal cost, was to remain detached from the prevailing sentiment. When the market is characterized by widespread euphoria, when even the casual observer talks of easy money, and when prudence seems to have been abandoned, it is a powerful signal that the peak of the advance may be near. This psychological excess, this dangerous cocktail of greed and unfounded optimism, is a consistent precursor to a market reversal, a warning whispered by the very behavior of the crowd. Beyond the psychological indicators, Jesse Livermore developed a more concrete approach to discerning market tops, centered on his powerful concept of key points. These were not arbitrary price levels, but rather critical junctures where the market's underlying character subtly, yet definitively, shifted. For Livermore, a market top wasn't a single, explosive event, but a gradual process where the prior bullish momentum began to falter, and the market, in his words, ceased to act right. This cessation of right action was the most telling signal that the tide was about to turn. Livermore meticulously observed that a market, or an individual stock, would often test new high ground, pushing to new peaks. However, at a true top, these attempts to advance would be met with unusual resistance. The market would push up, but then quickly recede, unable to hold its gains. It would perhaps try again, only to falter once more. This repeated failure to sustain new highs, even in the face of what seemed like good news, was a crucial indicator that the buying power was exhausting itself and the line of least resistance had shifted from up to down. A significant part of this rule involved keenly watching the behavior of market leaders. In a healthy bull market, the strongest, most prominent stocks lead the charge, consistently making new highs and pulling the rest of the market along. At a market top, Livermore noticed that these leaders would begin to falter. They might still make new highs, but their advances would be narrower, their retreat swifter, and their overall vigor diminished. When the generals start to falter, it's a strong signal that the army's morale is breaking. Their inability to sustain strong upward momentum was a profound warning sign that the broad market's underlying strength was eroding. Furthermore, Livermore emphasized that market tops are rarely sharp V-shaped reversals. Instead, they are typically rounded affairs, or a series of minor peaks, where prices repeatedly try to push higher but repeatedly fail to hold those gains. This drawn-out process allows the astute observer to notice the subtle changes in the market's character, the increasing volatility without significant net progress, the reduced responsiveness to positive news, and the general sense of exhaustion that begins to permeate the trading action. These nuanced shifts, often imperceptible to the emotional or casual observer, were loud and clear to Livermore. Subscribe now, leave a like, and write any comment. This way, you'll help more people see and hear this message, and I'll know that my work is not in vain. Therefore, for Livermore, detecting a market top was about recognizing this change in character. It was about understanding that the market was no longer acting right, no longer responding in a fundamentally strong way to bullish inputs. This required immense patience, detachment, and an unshakable commitment to observing the market's true behavior, rather than being swayed by the prevailing optimism or the superficial headlines. The market always reveals its intentions, but only to those who are disciplined enough to listen to its true language of price and volume action. One of the most potent technical indicators Jesse Livermore relied upon to confirm the presence of a market top was the behavior of trading volume in conjunction with price action. It's a counterintuitive observation for many, but Livermore noted that when a market or a leading stock made new highs accompanied by significantly increased volume, yet failed to make commensurate, sustained upward progress, it was often a profound warning sign of an impending reversal. This particular pattern signaled that large smart money was quietly distributing its holdings to the eager, uninitiated public. Typically, strong advances are characterized by rising prices on increasing volume, indicating genuine demand. However, at a market top, Livermore observed a different dynamic. Prices might push to new highs, attracting immense public attention and participation, leading to a surge in trading volume. But critically, these new highs would not be sustained. The market would perhaps close lower than its intraday high, or reverse sharply, failing to build upon the momentum suggested by the high volume. This indicated that while there was significant buying, there was also an equally significant amount of selling occurring at those elevated levels. This phenomenon is what is often referred to as distribution. The astute large operators, having accumulated shares during the earlier, less enthusiastic phases of the bull market, use the period of public euphoria and high volume to unload their positions without crashing the market. They feed stock to the ravenous demand of the retail crowd, who are rushing in to buy what they believe are surefire winners. The high volume, in this context, is not a sign of overwhelming buying strength, but rather a reflection of balanced supply and demand at unsustainable price levels, with smart money consistently selling into that demand. Livermore understood that the uninformed public, often entering the market late in a bull run, is driven by the fear of missing out and the allure of easy profits. They are most active at the very top, when the market is making headlines and seems invincible. It is at this precise moment that the professional speculator identifies the subtle shift. The market is working harder, expending more energy, higher volume, but yielding less progress, failure to hold new highs. This divergence between effort and result was a loud warning that the market was becoming tired and ripe for a significant correction or reversal. Therefore, the critical lesson here is to pay meticulous attention to volume patterns as the market approaches new highs. Do not be fooled by simply seeing high volume. Analyze it in relation to price progress. When new highs are achieved on surging volume but fail to hold, when the market works hard but goes nowhere, it is a potent signal of distribution. This rule, honed by Livermore's vast experience, serves as a vital safeguard against buying into the collective euphoria and becoming a casualty of the market's inevitable, and often brutal, reversal. Jesse Livermore, throughout his long and often tumultuous career, continually observed that the overwhelming majority of speculators lost money not because of bad luck or unforeseen events, but due to their own ignorance and a fatal lack of objectivity. The market, in its purest form, presents signals and opportunities, but these are often obscured by the powerful human emotions of greed, hope, and fear that blind individuals to the obvious. The lessons about market tops, in particular, are frequently learned too late because traders are unwilling or unable to shed their emotional biases and view the market's actions dispassionately. At the very peak of market euphoria, when prices seem destined to rise indefinitely, the average speculator becomes most vulnerable. Their greed intensifies, pushing them to ignore cautionary signs and commit increasingly large sums of capital. This greed is often coupled with a dangerous hope, the irrational belief that a stock or the market itself will continue its upward trajectory indefinitely, or that a losing position will magically rebound. This emotional cocktail creates a powerful cognitive bias, preventing them from recognizing the distribution patterns, the waning momentum, or the changes in character that loudly signal an impending top. Livermore himself, despite his genius, admitted to being susceptible to these emotional traps early in his career. His greatest lessons came from realizing that successful speculation demanded an almost ruthless detachment from emotions. The market does not care about your hopes, your fears, or your personal opinions. It simply moves according to the forces of supply and demand. Therefore, to truly succeed, one must learn to observe the market's behavior objectively, without allowing personal biases or the prevailing sentiment of the crowd to distort their judgment. This detached objectivity is the bedrock of sound decision-making in speculation. The inability to disconnect from the crowd's sentiment is another significant pitfall. When everyone around you is giddy with optimism, when news reports trumpet ever-increasing gains, it requires immense discipline and independent thought to stand apart and question the prevailing narrative. Livermore consistently stressed the importance of trusting your own observations of price and volume, even when they contradicted popular opinion or the pronouncements of experts. The market's true language is its action, not the opinions of others. Those who succeed are often those who are willing to be lonely, to go against the prevailing tide when their analysis dictates it. Therefore, the profound lesson, often learned at great cost, is that survival and prosperity in the market demand a relentless commitment to objectivity and the eradication of emotional bias. Do not allow greed to blind you to risk, nor hope to prolong your losses. Learn to read the market's true signals, to trust your disciplined observations, and to act independently of the crowd's irrational exuberance. For it is through this cold, hard realism and unwavering discipline that a speculator gains the clearest vision of market tops, protecting their capital and ensuring their longevity in the unforgiving arena of speculation. Subscribe now, leave a like, and write any comment. This way, you'll help more people see and hear this message, and I'll know that my work is not in vain.